Hi, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the first quarter, both bonds and stocks rallied. Inflation trimmed to 5% from 6.5% last quarter end. The Federal Reserve again increased short-term interest rates twice last quarter, but only by 1/4% each time. We saw two bank failures this quarter. The government stepped in to make depositors whole beyond FDIC's $250,000 account limits. In the first quarter, U.S. large companies rallied 8%, as U.S. small company stocks rose 3%. Overseas stocks matched ours, up 7%. Bonds finally turned in a positive return, up 3%. Spurred by hopes the Federal Reserve may be done hiking interest rates. Expectations for short-term interest rates seem to be driving the stock market more than any other factor. The two bank failures led some pros to portend that the Fed will stop their interest rate hikes, we've had 9 so far, and possibly start cutting later this year. Inflation has moderated a bit. The stock market reflects all of that. Other pros, though, point to an inevitable drop in corporate earnings ahead and a Fed that may pause for longer until inflation is solidly back down. There's a downturn ahead for our economy. The questions are how big and how long. Earnings from large U.S. companies are expected to drop 5% this quarter from last year's first quarter. They dropped 3% last quarter. They're predicted to grow 1 to 4% for all of 2023. The stock market usually trades at values within 12 to 22 times these earnings. It's trading at an above average level now. Most businesses have been able so far to pass along price hikes and maintain their earnings. Most are slowing hires. Some are cutting their workforces. The higher capital costs from those Fed rate hikes should cut into growth prospects. Housing remains muted since mortgage rates jumped so much last year. Jobs are being created, but at a more modest pace. The unemployment rate is still tight at 3.5%. The size of the labor pool is still mincing up. Inflation on wages is 4%. What we buy is up 5%. Both are high. Real GDP grew 2.1% for 2022. Expectations for this year are 1%. That's low. Central banks in most of Europe and Asia continued to hike their own interest rates in the quarter to combat the inflation they're experiencing. Their stock markets are not as highly valued as ours. That can be seen as an opportunity, or perhaps is a result of the headwinds they face with the war in Ukraine and elevated energy costs. China has reopened. Dire COVID repercussions seem to be over there. Economic growth of 5% is predicted for 2023 for them. The average bear market lasts 14 months, and we're at that point now. To bring down inflation, the Fed has hiked interest rates up to 5.0%. A year ago, that was 0.5%. We've come a long way, baby. We'd expect inflation to start dropping meaningfully and the Fed to pause on rate hikes. The stock market seems itchy to drive higher, but hopes for lower rates and higher corporate earnings will have to compete with the reality of 2023. Yes, the stock market looks ahead, but usually only 6 to 9 months out. That's the tussle. The outlier, any bank failure contagion, could really change the landscape. Our portfolios are diversified over different asset classes, more so than before. As expected, bonds have started helping instead of hurting. Since we're long-term investors, we remember when the Fed fought inflation before, although it's been a while. Nor is this our first business cycle as investors. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.